to In the Harbor. I'm your host, Jason Johns, joined today by my co-host, Sean Richland. Welcome back, Sean.
Jason, I am excited to be here with you, my friend.
As am I, and today we have a great guest in Jordan Kienzle from Baker Street Advisors out in California. Jordan is a partner and chair of the investment committee, so I think we'll have a fascinating conversation just about their kind of evolution of their firm and their tremendous growth they've realized.
Yeah, it's been a tremendous run for Baker Street for sure, and fortunate to have the guy who does a lot of the decision making on the team join us.
So
thanks, Jason. Yeah, thanks, Sean. Happy to be here.
And with that, why don't we kick off? How'd you get into the industry, Jordan?
Great. Yeah. Well, yeah. Thanks for having me. My background was a little bit, non-traditional. So I grew up in Minnesota. My parents were both social workers. So they, came from a background of really just orienting around helping people. And, unfortunately, my father passed away when I was young from Lou Gehrig's disease when I was about 10. But that spirit of kind of helping people carried on. And as I got into college and looked at, what to do and kind of where my interests lie, it was really around, news and financial markets, and particularly investing. And that really became to me apparent when I was, an undergrad, and we were able to in my program get a free Wall Street Journal subscription. I'd show up at the dining hall at 7:55, 5 minutes before it opened. I'd be the only one there. I'd go in, get my breakfast, read the paper. Sounds a little old school now, but that really dawned on me of trying to follow the passion where your interests lie. And so from there, leveraged that, worked at US Bank and private wealth management around 2006 when I graduated, which was an interesting time because, as we all can remember, 2008 was a great financial crisis. And I was fortunate enough to be able to manage client money at US Bank in Minneapolis. And I actually managed a couple $100 million, which, believe it or not, for a 22-year-old was a little bit crazy, especially given the fact that most of these folks were, retirees. They were living off their portfolios, and that we entered the worst financial crisis that we lived through. And so it was a real eye opener for me to realize how important this money is for families. And from there, worked and got my CFA charter holder in the background, pivoted to Goldman, where different culture, really wanted to be immersed in more of the sophisticated investment strategies, and had a great time there, but ultimately realized that, a lot of that business was predicated on sales. And I was a little more focused on the investing, and at the end of the day, kind of helping my clients keep as much money as they could, mitigating some of the costs that come along with taxes and fees. So that's how I came to, find Baker Street after taking about a year off and living in South America and trying to reflect on what I wanted to spend the rest of my life doing. Found Jeff Collin at Baker Street through a former colleague of mine, and saw that what he had done, which was basically he pivoted from a Goldman type investment culture. He did come from Goldman along with a couple other partners, set out an investment advisor, an independent RIA, really predicated on trying to mitigate conflicts and be as aligned with the client as possible. And from that, really figured out, how do we use objective data to construct a portfolio that can hopefully allow clients to compound more, mitigate those two silent killers, which is really fees and taxes, and hopefully support their long-term goals. And now we're Baker Street, $20 billion, and it's been a great ride. And I'm happy to share more of kind of how that came to be. But that's really my background.
Oh, that's fascinating. I think just the you look at the years when you started your career actually managing money through the financial crisis.
Yeah, that's got to put a stamp on your philosophy a little bit, I would think, right? I mean, you started right in, and that is the background you have.
Yeah, I can remember actually, it's a little, it was interesting time because, I was right out of college, market had been going up for a while. There was a little bit of murmurs around, subprime. But I was naive. I was reading the paper, trying to figure out what was going on. I was also studying for the CFA, and all of a sudden you look around, things seemed normal, but the financial markets were anything but normal. And I think what was really dawned on me was when I historically didn't get that involved with the client side. We had a trust officer, a relationship manager that really managed that side. But all of a sudden they started asking, "Hey, we need you to come into this meeting. I don't know how to talk about this." And I was the young person getting in, and I could see on some of these faces of these clients, like, this guy's going to tell me this guy's going to tell me to relax, like this 22-year-old coming out of college. And it opened my eyes to, really how to think about risk, and mostly around the idea that, you can measure risk in volatility, you can measure risk using all these Monte Carlos, and which we do. But at the end of the day, people want to know if they can, whatever their portfolio is going to go through, are they going to have enough money to live off and really live the lifestyle they want. And so, that really shaped a lot of how I viewed, the next several years of my career, and trying to figure out, how to make sure that the clients that I work with, understand how we can best serve them, and thinking about not just portfolio risk from a standard deviation, but also from sort of a longevity piece.
Yeah, and I think that's the one thing that always gets missed when you're looking at a total portfolio from a risk standpoint, is the correlations. So in that math equation where 2 + 2 no longer equals 4, it equals 3 because of the correlation benefits.
Yeah. Things that you thought were, gonna be diversifiers in a down market, when liquidity dries up, they all go down. And so, it is an interesting, it happens, it repeats itself. Credit cycles come and go, and I think it's our job as advisors and folks to make sure that people are prepared emotionally for what this might look like and feel like when it inevitably happens again. But you're right. They do tend to accelerate on the downside, especially, and people always fail to appreciate how quickly things can go down, when things are sort of steadily going up for years.
Yeah, and that may be on the horizon again. I mean, history doesn't repeat itself, but it rhymes, and there's a lot of rhyming going on.
You're right. So yeah, I think, as products have gotten more complex, folks have pivoted towards more alternatives. There's more hidden risks, and I think that's where, folks have to really do their amount of research and understand, like, have we seen this through a cycle before? What kind of proxy could we use to get a reasonable gauge? And they have to be very realistic about, what this might look like in a new regime. And frankly, it's hard to just look at historical data, especially because some of these markets are maybe more nascent than traditional stocks and bonds.
Absolutely.
I'd like to take a step back here. You were talking about, you took a break, went to South America. What during that time off, and where did you go? Talk to me about that journey.
Yeah. So I was working at Goldman. I was also starting to take evening classes at the University of Chicago Booth, and I like to be busy, I'd say. And I think for me, I was kind of burning the wick at both ends for a few years there, and I was getting pretty burnt out. And it got to a point where I wasn't investing in relationships at all. You're just working a lot. You're doing all this stuff with the idea that this is going to help my career. I'm going to, benefiting, all this stuff is going to accrue to me. But there gets to be a point where you wonder, well, especially having lost a parent when I was young, you do reflect on this idea around, what's a good life, a meaningful life. And I think I was entering that point where, for a lot of folks that go to firms like Goldman, you know this term like golden handcuffs. And this is the concept where you're doing pretty well, and you have this idea that, hey, I'm gonna make it this level, and then I'll leave and I'll go and do something different. But you start making more income, and you start having a lifestyle that you like. You start traveling a certain way, and pretty soon it gets a lot harder to leave that career path. And so I had a point where I was going to basically transition into being an advisor. So creating new clients, or I'm going to have to take a step back. And I think the business school piece gave me a good transition, because Chicago Booth offered the ability to earn a couple class credits at different schools. And one of the schools, the only school basically in South America, was in Chile, and in Santiago, which they had told me it was going to be in English. It was actually in Spanish, so that was quite difficult. I did know Spanish pretty well, but learning, third level business classes in Spanish in Santiago with a bunch of Spanish classmates was a bit challenging. But the experience was eye-opening, because it did give me a chance to step back, to basically get back to a simpler lifestyle and kind of reflect on what the next several years I want it to look like, from both relationships and work. And I effectively home-based in Chile, Santiago, for the first 3-4 months where I took classes. And then I traveled basically Colombia, Uruguay, Paraguay, Peru, all over South America for another 9 months, and had a great kind of amazing adventure. and then realized I needed to actually start making money again. I was going to blow through my savings pretty quickly. And so I moved back to California because I really also wanted to find a geography that was more aligned with my lifestyle, which was I like to bike, like to hike, run, things like that. And had been living in Chicago before, and Chicago during the winter, there's not much to do other than go to the pub and watch sports. And so I went to San Francisco and found Baker Street, and that's really how I ended up here. And that was about 14 years ago.
That's pretty awesome. What a great story. So talk to me about now. So now it sounds like when you need a break, you go cycling. How do you incorporate that into your daily life?
Yeah, very intentional. I have 4 children now. I've got an 8-year-old, a 6-year-old, a 4-year-old, and a 2-year-old. And so I could say that cycling is
good spacing.
Yeah, good spacing.
Cycling has taken a back seat for sure. But the benefit, as I live in Marin, so Marin County is basically just north of San Francisco, over the Golden Gate Bridge, and the benefit is there's a bike path, pedestrian path on the Golden Gate Bridge. So this morning I get up early and leave before my kids get up and get on my bike and ride into the office, and that's kind of a guaranteed exercise outlet. And then try to fit it in where I can if there's any opportunities on the weekend. But between work and family and trying to get a little exercise to stay sane, there's not much other time.
Well, and wait till the kids start playing sports.
Yeah, right. That's a whole other bag. Well, the 8-year-old's probably doing it. Do you ever attach the little sidecar to the bike and throw the kid in the back, or no?
Yeah, I have. So I've been stubborn because the e-bike craze has come along quickly, and so now there's all these great e-bikes, and I've been resolute in basically having my old school manual one. So I'm clicking this thing on the back and hauling people everywhere. But my kids are they're almost aging out of that. So like the backseat one I took off a few months ago. It was a little bit sad, but now it's like one in, one out of the garage. There's too many bikes there and stuff. So, but it is, we still try to get the kids out, and it's a nice community to be active. So that's a benefit.
That's really cool. So I got to tell you, last time I was in San Francisco, I did take a Waymo for the first time. And the bellhop at the hotel was like, don't take the machines. You got to take a yellow cab. It was like a whole thing. What's your take on the Waymos in the city?
I mean, as a cyclist, I love them because they're predictable, and you can, be around them and be pretty confident that they're gonna slow down for you and stop for you. So to be honest, I view them as much safer than the general public driving around, especially downtown. And I hope my kids never have to drive, to be honest. I think, especially if you look at the numbers, it's one of the things that is scary as a parent. And so I'm embracing it, especially being out here. We have a lot of clients that work in these companies and, support a lot of this innovation. I think balancing some of the benefits with always the cost to the general public is important. But I like seeing them around. My kids are always excited to see them. People seem to like them. And, there are still times where the cab does make sense. There are times where you'd probably prefer a cab, and the pricing is actually not that different. So I assume there'll be a market for both.
That's interesting. I think it's one of those breakthrough events. You got to get through 1 or 2 rides before you're comfortable with it.
It's odd. It is odd. You sit in there and there's no driver and things just turning, going everywhere, but it's safer.
And there's no driver talking incessantly.
You're right.
I just want to go home. I had a long day. When
do you think you're going to have them in Montana, Jay? Are they going to show up in Montana anytime soon?
Boy, I don't think so.
No?
No. It's we're usually last. We're the last frontier, essentially.
That's fair. Yeah, that's fair.
Well, Jordan, why don't we get into Baker Street a little bit, because you've had tremendous growth. I mean, when I was looking at your ADV, I think in 2016 the firm was at about $6 billion.
Sounds great.
So over the last 10 years, you've grown 14 billion assets.
Amazing. Congratulations.
Thank you. Yeah. It's really a testament to the folks that have been working so hard for several years. I mean, Jeff Collin, for one, who's really the founder of the firm, who just recently retired last year, again, kind of built a firm that he would want managing his own family's money. And I think those key elements and key tenets have really benefited the growth and the attraction over the years. And I think what we've always said is we we oftentimes will get clients after their first or second advisor experience, meaning they might go to a big investment bank or something that has a big name, strong name, and get to know somebody and kind of realize it doesn't feel like I'm getting the best advice that's oftentimes aligned with my own kind of long-term goals. And I always often say, the Charlie Munger quote, which is basically, show me the incentive and I'll show you the outcome. We purposely designed the firm to not have any incentives other than basically designed to optimize and maximize the long-term wealth of our clients. And I think a lot of times firms are set up with disincentives for that misalignment. And so they end up selling products and clients that, some clients are fine with that and they deal with it. But I think, a lot of folks, especially when my experience at Goldman, I always got the feedback. I think I got feedback 2 or 3 years in a row of not being commercial enough. And that really meant that I wasn't focused on, maximizing revenue per client as much as I should have been. And I think that really went into Baker Street's mentality of, how can we give objective data to clients, let them ultimately choose. We're going to give them the insight and the recommendation. But I think the benefit that clients saw was that they're keeping more of their money at the end of the day. And a lot of that number, it's both new clients and the high retention rate, but it's also retaining more of the money you're investing. I mean, the biggest friction is, as I mentioned, taxes and fees. And so if you can reduce the fee drag and the tax drag, you're going to save the clients maybe 200 basis points a year. If you think about that on $6 billion compounded over years, that's hundreds of millions of dollars that ultimately those clients will keep, but we're also going to be managing. So I think it's a trade-off. Like, you have firms that are designed to maximize revenue and maximize their value over the next few years, which is you can sell different products. Different private market products have high upfront costs. Those brokers get that money day one or day two or in the first couple of years. That's great for them. They're also relying on that. Might be stickier. Clients don't want it. They're say, this guy, they sold me this thing. I don't really know what it is. I don't want to leave them. Maybe they can manage it. That's not a long-term greedy move. That's a short-term greedy move. And I think for us, we've benefited some strong growth because I think clients realize, like, oh, well, I want the alignment in place with this firm. And that's kind of been a really big kind of wind in our sails for several years.
Yeah, I can definitely see that. And, focusing on your clientele specifically, typically the ultra high net worth,
yep.
There's probably a lot that goes into that, just because each client is going to be complex in some ways, and in a lot of times, a lot of different ways.
Yeah. And you're exactly right. There, no two clients are the same. And I think the biggest key though is, you get back to the basics of what are you solving for? Some clients who we labeled as, how funded are you? Basically, what are the chances that you're going to outlive your money? If you're very well funded, almost like a pension scheme funded, you're significantly overfunded. There's no chance, there's no environment that would render you not having enough money to live off of. Those clients might have goals of, I want to maximize philanthropy, or I want to maximize how much money I can transition to next generation, or all these other aspects. There's other clients that maybe they have a really higher lifestyle spend, and we're kind of thinking they're equally funded. So as long as markets stay reasonably moderate, they're going to be fine. And you kind of run the gambit of clients with concentrations of stock. Maybe they were an early employee somewhere that's done really well. You got to manage that risk. You have other clients who have their own businesses. You're trying to figure out succession plans. And the benefit is for us, it's super exciting. We're learning every day. We're always trying to keep improving our knowledge. We're leveraging, experts in the field where it might be the best trust and estate attorneys, the other accountants and things like that. But every day I get an email that it could be wildly different from the next. And that's part of the reason that I was drawn to this business. When I was younger, as I mentioned, I liked the idea that financial markets were kind of like puzzles. You're so many inputs, but it's also a very wicked environment where you might on the outside think, hey, this would mean A would mean B because prices are going up, earnings are going up. But as long-term observers of the market, we all know that that's not as simple as it sounds. Most of the time, a lot of times, things you'd think would go up actually means things are going down. And so I think for that, you layer in the psychology component where people are humans, we're irrational at times. Clients are viewing this as, all their assets. It's a very highly emotional aspect. You have to marry the financial, the objective data with the reality that you're working with somebody on a highly emotional aspect, and that's a big piece of how you can help clients and how we make sure that we're not completely separating the emotional psychology from financial market objectivity of the data.
And I guess in that realm, what always fascinates me is how you incorporate the other advisors within the family. So the tax practitioner, the estate planners, like how do you bring that all together?
Yeah. And we typically serve as the financial quarterback. So we're really the ones that are, air traffic control on that piece. And so what would typically happen is we don't have trust and estate attorneys in-house. We deliberately didn't build this stuff in-house because we always think that we want the client to have, the best trust and estate attorney for their situation. And not every trust and estate attorney sometimes has different specializations or different states. There's different reasons for that. So we make sure that we have basically a strong relationship with a number of trusted estate attorneys, a number of accountants, a number of different attorneys for different aspects. And then when a client engages with us, and then we either they have an existing attorney or we connect them with a couple folks, we are the ones that will kind of quarterback that flow of information so that the client doesn't have to get involved unless there's a major decision being made. We call these, we work with what we would call an informed delegator. They could probably do the work if they wanted to, but it takes so much time, and they'd rather outsource it to a group like us so that we can synthesize the information, give them the trade-offs, an ultimate recommendation, and then coordinate on the back end, getting all the actual processes in place, signatures, if they wanted to open an account for the benefit of their child, if they wanted to think about more complex trust and estate transitions, we're working through that aspect for them. We're really trying to take all that cognitive load off our clients so they can continue to do the things they want to spend their time on.
It's one of the things that is so hard in our world is just navigating all the complexities of an overall financial plan, and being the quarterback there for them is comforting for the client to make sure that you're utilizing some of the most effective other talents that you guys can integrate into your system. And that kind of falls into one of the questions that I have is just on client behavior. And what do you see people consistently make when maybe they're not with you, they come in, they're interviewing your firm, and what's something you consistently see as a mistake that is popping up regularly?
Mm-hmm. Well, there's a couple of key mistakes. There's mistakes where, let's say a new client comes to us and they're with somebody else. They send us the statements. Usually they're just over complicated. They've got, tons of line items, none of which they really understand exactly what the purpose of the portfolio is. They're probably paying way too many fees. They also don't have any idea of what they've actually paid in taxes. So that to us is a red flag of, basically there's not enough transparency in the industry. And I think that's the challenge and sometimes the negative mark that financial advice or wealth management gets is because it can be purposely opaque. We look at statements from a bunch of different firms sometimes because prospective clients will send us these statements, and you'd be shocked. It's hard for us sometimes to figure out how this client's done. It's like, who knows? We don't know if they've done relative to the benchmark. We don't even know how they're trying to perform. And so I think that piece is for us when we see a client's portfolio that has tons of line items, that's a big mistake because most likely they're paying too much in fees. They're also paying too much in taxes. And oftentimes some of those products do have upfront fees that, we don't think is necessary to get the portfolio construction, portfolio appreciation in the business. And so that's an area. I mean, the second area is just the piece that they're just not focusing on taxes. So for us, we're in California. Clients pay significant, 54% marginal rate, top rate between state and federal. That's a lot of money going to the governments if you aren't thoughtful about what investment strategies and vehicles you have. A lot of our bread and butter has been in tax loss harvesting, more index type oriented strategies over the last several years. those have now cropped up in significant popularity because the data is pretty much overwhelming that those have benefited clients the most, and you can get significant lower fees on that exposure. And so we really try to educate clients around what money are they actually keeping at the end of the day. How can we optimize their portfolio to align it more with kind of the tax profile, as well as taking advantage of some of the the benefits and diversification benefits that might be in other asset classes like alternatives, that could complement the diversification.
And that's one of those things in our industry that sometimes there's this perception that more line items is better.
It's not.
And less line items is worse. It's like you just want that perception for the client when they see the statement. But the reality is, I mean, especially when we look at like just ETFs, the amount of overlap you can get between different index providers. A lot of times you'll have unintended, like maybe you're overweighting mid cap unintentionally because you're using two different large cap index providers.
Yeah. I think the other piece, I mean, I think there's oftentimes it's a little bit of just being lazy. It's like if an advisor's, maybe the client's calling, hey, I'm worried about the market. What's going on? And they're like, yeah, oil's going up. We should add some oil exposure, just to hedge. And they stick it in there. And then it's like, next month I'm worried about tech's selling off. Oh yeah, we should add some consumer staples. Let's buy that ETF. Pretty soon, after 5 years, you've got 35 different ETF sectors, and they basically are just the index. You just bought the index, and you're probably paying more because each of these ETFs are actually more than an index ETF. So I think it's somewhat driven because I think advisors don't like to tell a client no. They want to have a solution for everything. And I think what clients actually need is they need an advisor to tell them, look, I understand you're concerned. Look at your portfolio. You actually have exposure to oil because 5% of the ACWI is actually in energy services, and so you can see this correlation. Now we can argue about whether you should have more. That's going to be dependent on what are you spending your money on personally? Do you have any other natural resource exposure in the portfolio? How much duration is in your fixed income portfolio? These are to figure out the correlations. But the advisor actually needs to be able to push back a little bit because it's natural that clients are going to worry. It's natural that clients reading the paper, headlines, talking to friends are going to wonder if their portfolio is optimized. And that's really, it's really incumbent on us to basically have the confidence to tell them, no, we should not add another line item. And this is why.
So, and that leads me to your seat currently as the chair of the investment committee. What goes in when you have a new idea that you want to implement across portfolios? Kind of what does that look like, and how onerous is that process to go from idea to execution?
Yeah. We spent a lot of time thinking about the right structure and governance. And from, I also want to caveat, we do often use alternatives or, private investments. I think we always the philosophy is kind of the Occam's razor. If we prefer to do the simpler approach if possible, but there are times where it makes sense. And, we manage around, over $3 billion of alternatives across, private equity, venture, private credit, natural resources, infrastructure, real estate. And so most of the time when we're going to investment committee, it's for a recommendation on a new private fund. We do also review our stable of public managers annually, but these are tax efficient, tax loss harvesting public equities that if we're meeting about that firm, that company, we're usually trying to negotiate lower fees. But so I'll sort of set those aside and say that our governance and investment committee, it starts with in the group, the investment strategy group within the firm. And these are the groups, these are the folks that are covering manager research. They have the relationships with the managers. We'll determine that, across the portfolios, across our client allocation, based on the target allocation and the current allocation of these clients in aggregate, what asset classes do we need to look to deploy capital? So for instance, we have a cash flow model that can project distributions, capital calls. That helps inform us how much time we should be spending on each sub asset class. So maybe we find out that we got $100 million to allocate to private real estate this year. Let's make sure we're talking to a number of the real estate managers. From there, the investment strategy group will identify a couple of the key groups or teams or funds They might be repeat funds. They might be funds that we've invested with before, or it could be new funds. And then they'll propose it internally to their group, which will then be vetted before there's a ton of work that goes into it. And once they get the go ahead, they'll do the research. If they get it approved, it goes to investment committee. And there's really the core tenets of whether a strategy will fit with our mandate is really around alignment. Alignment is one of them, like skin in the game. I think we all can agree that it's better to have a manager that is aligned with their own strategy than to have misalignment, whether it be non-incentive, non-economic alignment or things like that. So we like skin in the game with either their GP commitment amount or even do they own the firm? That's even better. How much carry are they getting? What's the carry going to the team? Then we have a second piece, which is basically tax efficiency. Sometimes these strategies aren't tax efficient, but many times you can determine how tax efficient it is with what's the average hold time. Even if it's a private fund like private equity or venture, you can get a sense for, is this a type of fund that holds these companies for several years, or is it a type of company that might sell it in a year or two, and there's a different tax profile for that? The third is really kind of downside risk. As I mentioned in the beginning, you can quantify risk in public markets pretty easily. You can look at volatility, how much the value deviates from sort of the expected return, standard deviation. The big one with privates, because it's so hard to disentangle what's going on, these aren't marked companies. They're not, you can't pull data from what the underlying companies are on a daily basis. They're quarterly marks. They tend to be biased. I sit on some LPACs, some limited partner advisory committees to approve the marks. And, it's kind of like people sitting in a room trying to figure out, does that valuation make sense? So these are not, I can sell this right now. So you have to be thoughtful around how you measure risk in these portfolios and these funds. So we really look at how much downside exposure does this fund actually have in terms of what kind of, would it be a complete loss, things like that. Then we have a targeted return. So what kind of return above a public proxy could this get? If it's a private equity fund, you can use a public proxy, such as maybe micro caps or smaller caps, and get an idea of, has this performance been consistently significantly above what the public market offering could be? Because if you're going to lock your money up and pay 2 and 20, you want to be really confident that this firm is doing something different and adding value. And I think those are the key tenets. I think the one other piece I would add to it is we are natural skeptics of kind of the ability to outperform consistently. I think we look a lot. We get a lot of insight from Nakubo. So Nakubo is the group organization that will put out what the endowment performance has been each year. And they've been publishing this for 30 years. So you can go and pay for the service and look at what endowments have performed, how large endowments. And I think most people can agree that the mega endowments, the Harvards, the Yales are pretty sophisticated investors. They've got big built out teams. They get high access to funds. They've got every reason to outperform. They also don't pay taxes the same way that individuals. Well, if you look at the data, you go back, we have the data in the charts. If you look at the data for 30 years and you look at rolling returns and you benchmark them against an all public portfolio, what you'll notice is returns in the beginning, so in the 70s and 80s, were significantly higher than public. It was about 500 to 700 basis points annually. Great, they had alpha. But then as you get closer into where we are today, you start seeing that alpha compress, and actually it's been negative for a number of years. So what you're seeing is, well, these are dynamic markets, and like every market, if there's profits to be had, new entrants come in, they compete away the alpha. And so we are really thoughtful that we don't necessarily sell alternatives as a way to add alpha or add necessarily higher returns, but there's a way sometimes to get additional diversification benefits through areas of the market that you wouldn't necessarily get in a public portfolio that we all know is highly concentrated in technology and mega stocks. And so we oftentimes make sure we reframe the conversation with, we're not looking at alternatives to maximize returns necessarily, but we are trying to maximize the return per unit of risk in the portfolio.
Oh, I think that's an interesting way to look at it. The endowment information in particular is fascinating, and how that's outperformance has shrunk over time.
Yeah.
But the diversification factor is massive. Like like we're going through here is if you look at historically the diversification factor from publics,
Right.
it does help the portfolio, and I think that makes a lot of sense what you're saying.
Well, and I do think, I mean, just given the proliferation of alternatives now available to more people, like if you think in the 80s, it was likely mostly endowments, very sophisticated institutions,
Family offices.
of course, family offices. Now it's, you know, kind of across the board. And you have the iCapitals of the world, the Cases of the world for access points and different feeder funds. Has that complicated things?
You know, I think having, you know, more, you know, as people kind of the democratization of alternatives. I mean, the opening up the markets is a good thing. More access to capital helps companies raise capital less expensive. I think for the average investor, I do think it can be sometimes negative in a sense that trying to disentangle what these alternatives do and understand exactly what underlying risks they have. I think we've seen that with, you know, these mega funds like BREIT, so Blackstone's REIT, a lot of the credit funds. Clients are oftentimes promised the benefits, but not really shown exactly what the negatives could be. And I think, you know, the one benefit I had with, you know, being in the financial markets during the crisis was seeing how quickly liquidity dried up. And we had clients that had, at the time, there was these variable rate municipals that were really short dated. They were designed to be basically a cash alternative. You get a little bit higher rate, but most folks should realize, you know, nothing's for free, and effectively these things would reset weekly. Well, when credit markets froze up, the reset was about, you know, 400 basis points higher than before, and those things lost a ton of money. They couldn't sell these things. All of a sudden, clients who thought they were holding cash were not able to access money. And so I think the challenge with a lot of these products is they're promising liquidity, but the asset liability mismatch is present. And you know, we've written a lot about this internally, and we actually have not done any of the perpetual credit funds because we just never got fully comfortable with a little bit of that asset liability mismatch. So I think for certain clients, and if they have the right expectations, it can make sense. But I do think it brings some challenges and some additional complexity to the regular sort of maybe lower amount of investable assets that they probably shouldn't have locked up in illiquid or semi-liquid products as much as they might be told.
Do you think that's why we're seeing such a rise in secondaries?
Yeah, we are committing actively to secondary strategies right now. We've always had a long-standing kind of commitment to secondaries, but we've recently kind of increased the allocation even more so because, again, yeah, you're right. You know, it's effectively a mismatch in the asset liability, and what you find is clients before a crisis, clients are comfortable taking that risk, and I think the managers, you know, the Blackstones, you know, Cliffwater, all these different groups really try to be intentional about telling the advisors and telling people, look, you can't expect to get this out. We're going to provide some liquidity, but inevitably, we're all humans. As soon as something starts looking bad, well, I better get it out. I got to rush the exits, and I think all of that stuff exacerbates this challenge. And so, we as investors and allocators, we want to be liquidity providers, not liquidity takers, because that you're going to get hit on a haircut on that. So in this current environment, we think it's going to be beneficial to be a liquidity provider in the form of secondaries, where there might be groups out there that can be patient capital and say, okay, this fund needs to create significant liquidity right now, and they're willing to take a haircut. And if it pencils out, that's a really high risk-adjusted return. So for a lot of folks, we think that's a better way to play it than you know, maybe some of the other areas. But again, that's with the expectation that these are locked up funds for 10 to 12 years, most likely, maybe even more. And so you have to be mindful of how much illiquid capacity you actually want on your overall portfolio, and if that's going to impact your long-term goals.
Right, and the nice thing about secondary is it shortens the J curve.
For sure. Yeah.
Right, and if you have an investment thesis where you like that, you know, that area, then being the liquidity provider, as you said, you're going to get a better deal. You're going to get
quicker.
You're going to get quicker, but you're going to get the same same investment you wanted as a primary in the secondary market at a haircut.
Exactly right.
That does wonders for your IRR.
Yeah, absolutely. All right, Jay, where should we move on to here now?
So I think why don't we talk about what's interesting in the market today for you? What are you actively looking at that could be interesting? I know you were in the Wall Street Journal in April talking about kind of everything we've seen recently with geopolitical conflict, and of course, we know the real reason you rode your bike to work was the gas prices in California.
Those ferry prices hasn't flown through the ferry prices either, but yeah, again, like it's the markets. This is why I got into financial markets. It's so interesting, and every day it's a puzzle to figure out, what might happen. And oftentimes, even if you were right, the market reacts differently than you thought. And so everything, when we talk about kind of opportunities. While there might be some shorter term opportunities, these are still views that we would have to be aligned with in whatever scenario plays out. And so for most of our kind of current strategies, we are trying to focus on areas that we think will be resilient across a bunch of different areas. Now, with that, a lot of it's around private real estate right now. Private real estate, for one, has probably been the worst performing asset class for the last 5 years. If anybody has allocated to real estate or private real estate over the last several years, they probably are reluctant to invest in private real estate. And that to us is usually a sign that, that waning demand is actually going to improve pricing, improve valuations. And if we can get comfortable around sort of the longer term demographic trends, household formation, the manager's actual selection of what kind of properties, what kind of debt they're putting on, we think it's actually a really good investment opportunity there. So we're spending a lot of our time on real estate, kind of multifamily, in particular, areas that really got hit hard post-COVID when rates spiked, and there's been a lot less supply coming on board in the last few years. The other pieces, we're always investing in infrastructure. We do a lot of infrastructure secondaries. We talked about secondaries before, which we agree kind of mitigates that J curve, and it also mitigates the complete blind pool risk, where you don't exactly know what you're actually buying. The secondaries allows that manager to be able to see what has already been purchased and make some pretty good decisions. Now, there's so much going on in infrastructure these days across both geopolitical. There's a lot of changing hands and ownership on ports and transactions and transportation, as well as obviously the AI build out and energy. And so our view is not to overweight any particular theme, particularly because you got a lot of adjacent exposure in public portfolios, but we want to be in sort of the picks and shovels group where you got managers that are going to benefit. They're not going to hit home runs, but they're going to hit consistent singles and doubles across, whether the AI is more of a bubble and it kind of fizzles out a bit, or if it continues to accelerate, you're going to hopefully have that exposure benefit in the portfolio to give you some additional diversification and cash flow, as well as some inflation protection if this ends up being more inflationary. So really, those are a couple different themes that we're focused on.
Yeah, the multifamily one is one we're hearing a bit right now. I'm curious on office and what your take is. I mean, you're in the heart of San Francisco, which had some major office issues as far as that goes. But we're hearing a little bit of pickup. Do you sense that in your hometown?
I do. I think there's definitely more optimism now. I mean, I just read an article in The Economist about how many startups, certainly AI, in San Francisco in general. And it's astounding across Anthropic, OpenAI. These companies are definitely absorbing some of that office space. I think when you look at, just anecdotally, walking out on the street, we're far from where we were in 2018. And that's more, I think, a function of tourism being down still. But from an office space absorption and prices, the top properties are still actually commanding quite a large premium. And so it feels like there's a lot less vacant offices. There's a lot more folks in the office. I have friends now that are required to be in the office 5 days a week. Some of us voluntarily are in there because trying to get away from the loud kids at home. But
Yeah, it's
but
hard to work.
but a lot of folks that are, there's more folks that are being mandated into the office, and I think overall it's definitely helping some of those trends and the companies and stuff. And so we haven't ever been big office investors, mostly because the tax profile is not great. With multifamily, you have a lot of depreciation benefits. You can cost segregate. So if you're doing renovations, you can accelerate depreciation. It's a much more tax efficient profile to invest in for a taxable client. Office, you're getting just ordinary income, and generally the non-diversification of the tenant is not ideal. But if you're doing core office, for certain people want that exposure, and I think that's improving from a long-term benefit as well.
Yeah, we've heard that about San Francisco. Part of that has to do with AI, I think.
Sure. Oh gosh, it's
That's
massive.
going to be the hub. And you mentioned some of the big ones, but there's all the ancillary companies associated with those.
Mm-hmm. It'd be interesting once these companies go public, and you have so many people in the Bay Area that are going to have highly appreciated stock, and that's got to be. I'm sure you come across it every day out your way.
Concentrated stock positions too. How do you manage around that?
Yeah. That's a good problem to have for a lot of clients. And, there's a couple of things. You want to have enough. Our view is, let's say you're somebody who just has concentrated stock. You want to have enough. You're going to have to take some taxes. You're going to, you can use some offsetting. You can generate some losses in other parts of the portfolio if you have initial cash that you can do it. But if you have just concentrated stock, the only thing you can really do is, depending on if it's an equity or options, but you can use some of these tax loss harvesting strategies, these, particularly some of the new, more innovative long short strategies, where you can generate and accelerate some of the losses by still getting index exposure, but then you can sell off some of your existing stock without triggering a complete amount of capital gains. The best situation is if you have qualified small business stock and you don't, and you could basically sell without a federal tax hit up to $10 million. So we first figure out, is this QSB a stock or not? Second is, all right, we're going to sell some stock. How can we do that with the least tax drag? Because we want to make sure that whatever happens in this company, whether everybody's obviously confident their company is going to continue to do extremely well, but our business is really in risk management. So we want to have enough of the portfolio supporting a lifestyle regardless of what can happen. And then once you get past that piece, then it's really around how much could we maintain in this stock without completely, jeopardizing the long term, or at least like having such a wide path of opportunities where we can over time try to diversify this. You can use exchange funds. We use a lot of CRUTs, so charitable remainder unit trusts.
Mm-hmm.
You're able to put some highly appreciated stock into a charitable remainder trust. You can diversify it in there. You receive a income flow for the next several years, depending on the CRUT structure. You will end up paying some income taxes, but you're deferring the taxes and you're able to offload the risk. And then there's strategies. There's a lot of strategies on the estate planning. If your second goal is, I want to pass some of this money to my kids, you could use some of that within a GRAT structure, or even some, kind of family limited partnership stuff. But California is pretty harsh on taxes. And so at the end of the day, you're going to have to pay some amount of taxes, but it's really about how quickly you need to diversify out of this product. I think the challenge always is, if you look at base rates, if you look historically around single stocks, if you just take the average, you basically never want to hold this long term. Now, we've benefited because a lot of the clients, and some of my clients have actually been in the companies that have proliferated and been wildly successful. So I think for me, it's actually been sometimes challenging because you look back, every time you've diversified, it's actually been the wrong economic move,
Right.
even though it's been the right kind of portfolio move. And so I think you have to marry those two with, if the client has a really strong desire to hold a material amount, you got to just find out what that number is and walk them through some shock scenarios. Here's what could happen. No stock's going up forever in a straight line either. And so it's walking through the emotional aspect of that with each client, especially newly wealthy clients who have concentrated stock, because oftentimes they haven't seen the public markets. They've seen a private market tick. Every time it's gone up, new fundraising, their company's always in the press about how great it is. I think that's the part where you have to educate folks around the reality of, equity risk.
Well, and that's the reality of what you talked about at the beginning when you focus on risk management. And that's ultimately what you see your job as.
Yeah.
Where if you have all of your wealth tied up in one stock, regardless if you have faith in that company or not, diversification starts making a lot of sense.
Yeah. And it's, I think we all remember those stories, those really tough stories about the employees that held, all their money in GM or GE and went through the crisis and lost everything. And those are easy to go back and say, why would you ever do that? Your income is already tied to the company. You're over leveraged to that company. But then in real time, when things are going well, it's hard. There's a lot of regret. We think a lot about sort of, regret avoidance. Like how do you, because clients we're all human. Same with me. If I sold something that ended up going up, nobody's ever selling something later on going to look at it and say, well, my risk is lower. I'm glad I sold that, even though it's doubled. They're always going to look back and say, should have held it, should have held more of it. And I think that tide can change quickly. And so, our ability to sort of marry the psychology with the financial, show folks the data. Hey, look, I know you're confident. You're going to continue to have significant exposure to this company. We hope it goes to the moon, but you also need to make sure that you're protecting yourself in a negative situation. So there's aspects around that are difficult, and you can't always perfect it, but you can get the clients to be as candid as possible. You can walk through the scenarios, and it gets you to a place where I think both people are going to be satisfied, whether if the company goes to zero or if it quadruples from here as an outcome.
Well, and that's where you have to put on your psychologist hat too, because everyone's going to focus on, say you sell something that appreciated 20% and then it doubles from there. They're focused on, intuitively the way they think about it is how much money they lost by selling that at a 20% gain.
Yeah. There's, I spent a lot of time focused on the behavioral finance aspect and reading, Daniel Kahneman, and there's prospect theory, which is basically loss aversion. So you feel the losses 2 times as hard as you feel the gains. There's always hindsight bias. Folks are all that's one of the hardest ones to overcome. Folks are like, I knew this company was gonna. I knew. Think about how great this company is now. But one thing I try to introduce is, there's if you study or you actually monitor what's going on in the markets in real time, you appreciate how much uncertainty actually is out there and how much the trajectory could differ. And so I think that gives you an appreciation. But if you're somebody who's a client or an investor who might work at a company, maybe all is this is a sure thing. And so I think we have to be careful about that hindsight bias seeping in, where people look back and assume that they were right the whole time and everybody else is the reason, they were wrong. And how could you even think that this was going to be? So anyway, you're right though. There's a lot of psychology aspects that are at play here. And it's a super interesting part because it is dynamic, and every client has a little bit of a different psychological bent to them. So you have to kind of cater your conversations around that.
We talked a little bit when we first started here about you loving to read so much and sneaking in early to do that. What are you currently diving into, and what would you recommend people should pick up?
Yes. So I think a book that I've come across over the last few years, the Morgan Housel book, Psychology of Money.
Psychology of Money is a good one.
It's gotten that one to me is a fairly easy read, an interesting read, and it really emphasized a lot of the key lessons around successful investing, which a lot of it's around just having your money compound. Whatever you do, try to not stop the money from compounding. And so it's, long-term savings, a lot of these sort of standard practices. And I think he has a good way of narrating about risk and some of the stories. I think in other terms of, I'm a big podcast guy too. And so I'll listen to a lot of things on audio. But I stick to I try not, to be clear, I read the Wall Street Journal every day, but I try not to dwell on it too much because, as we talked about a lot, I actually think too much information can be negative for folks. And so I have my weekly Economist, which is gives me sort of like the global view, and then I read the newspaper on. And sadly, I'm not reading it physically anymore. That was a while ago, but I still read every day. And so those are kind of the key areas that I'll Bloomberg and things like that. We just have what's going on in the news, and then from books, the Morgan Housel book's good. I'm recently reading this Paul Bloom book on the joys of suffering, and it's I think all parents out there, sometimes need a kind of a approval around, hey, this is long-term good for everybody, even though sometimes parenting can feel like you're just kind of suffering through a lot of things depending on where your kids are.
But. Yeah, I think that's a fair statement for everybody. It's tough. $1 Trillion Coach. Have you read that yet?
I have not.
It's a good one. I'm in the middle of it right now. I don't know if you've had a chance to read that one. It's based in your area, and the story of Bill Campbell. It's a good one.
Did you read Andrew Ross Sorkin's 1929?
Oh boy, here we go.
I saw you reference that on a different one.
Yes.
I've read Too Big to Fail, but I have heard good things about that one.
I learned so much in that book.
Yeah. I felt like you came out of it bearish, though. I mean, you came out of it bearish.
I was bearish going into it. I came out of it really bearish. Sky is falling.
Right.
Now I've changed my tune a little bit.
Okay.
Well, I think we can end. Let's just do some rapid fire questions, if that's okay with you.
Great.
So, being from Minnesota, favorite sports team?
Twins. Minnesota Twins.
I thought I was going to go Vikings and my buddy J.J. McCarthy. We could give a little hit to Michigan sports here, but
I was going to say Minnesota North Stars, but that was that was before they moved to Dallas. I don't even know where they are anymore, but that
Dallas.
Was yeah.
You grew up in the Madonna era there.
I was Mike Madonna. That was Darian Hatcher. There's some that was a fun time. I didn't play hockey, unfortunately. My mom did not let me play hockey. It's too physical, she said. So, but I enjoyed watching the North Stars. And then I actually moved to Dallas for a couple of years, and it was the same time they moved. So I felt like a good allegiance to Madonna.
Yeah, well, the Twins are in the AL Central here with our Tigers. So, it's a good battle every year.
Yeah.
We already asked favorite book. I kind of jumped the gun on that one, didn't I?
Well, I knew what you were getting at.
Did you?
Most overrated asset class right now?
Ooh, I like that question.
I mean, I have to say, this is kind of I would say just all the AI, like SpaceX, these are like privately, SPV vehicles. I'd say like the overrated would be, I'm going to pay whatever it takes. I'm going to go in whatever structure, whatever SPV I can find to get access to the SpaceXs or the Anthropics. I'll say that one.
Yep. I would tend to agree.
You talked a lot about passive management and how much you like it. One area in active management that still wins.
I'd say, from a fixed income management standpoint, where you have either a municipal portfolio or something more dynamic, we do think that, a lot of times the passive benchmarks are built as a market cap weighted similar to equities, but in debt space, that just means you're going to have more exposure to the most highly indebted companies or countries. So we do feel that structural benefit, you should active management and fixed income, whether if you're a taxable investor, it might be tax exempt munis or other aspects, is still a significant advantage.
And I think to that point, munis often get overlooked in that aspect because how many individual issuers of municipal bonds are there?
Thousands.
I think there's like 75,000.
Seems like a lot.
Versus corporate bonds, maybe 13,000.
Yeah.
So it could be a much more complicated market.
Yeah.
So we got to ask this last question because I think it's a good one.
Go for it, Sean.
What's the biggest misconception about the markets today?
Misconception about the markets. Well, I mean, I think, what we constantly look at is the data, and I'm confused by it as well. I mean, frankly, the consumer sentiment is so low. There's so much negative. There's reasons to be negative that it's almost an opportunity to be more bullish. And so I think even a few months ago when we were looking at, oil prices, everything, there's so much reason to be bearish. I think the view is always, what's the hardest day to invest today? I think the misconception is that markets, everybody has to feel good for markets to go up. I think it's actually usually a lot of times where people are feeling not great, and that markets actually do reasonably well as people continue to kind of revise expectations. And so I don't want to be Pollyannish and view that everything's rosy, because there's some real cracks. And I think you want to be looking at your target allocation. You don't want to be significantly overweight on these aspects. But I also think the misconception is that it's a good time to buy when things seem good. It's actually, usually you want to be buying when things actually seem not so great.
Right.
I tend to agree. Which is why I didn't read 1929. I didn't want those thoughts to creep into my head.
I liked it from the historical perspective. Like, that was the learning. And then, there was like a dark cloud over my head afterwards.
I was like, I don't want to leave the house.
Yeah. Well, Jordan, really appreciate your time. Where can our audience and our listeners find you as far as any pieces you put out, be it LinkedIn or...
Yeah, so Baker Street Advisors, San Francisco RIA, BakerStreetAdvisors.com. I'm on LinkedIn, Jordan Kienzle. And so, love any, if folks are interested, we have been publishing we've been putting out more of the stuff that we've been publishing. We've been publishing things for several years, but we're going to try to be more active about sharing some of that information. So you can contact us through the website or find me on LinkedIn, and I'd love to engage.
Excellent. That's awesome. Well, we appreciate your time. Really enjoyed the conversation.
Great. Yeah. Thanks, Jason. Thanks, Sean. Really had fun with this.
Enjoy the cycle over the bridge home. Sounds like a fun day.
Will do. All right. Thanks, guys.